So I'm going to start with your outlook for renminbi denominated debt. Where do you see this asset class going in 2011?
Okay, so we have a background. The CNH bond market has grown very rapidly over the last 1 year. So in 2010, the CNH bond market grew 200% to about 60 billion RMB. We expect this market to actually double in size to about 120 billion RMB by end of this year, or roughly about US 12 billion, roughly about US 18 billion dollars by the end of this year. As for the yield, the current average CNH bond yield for maturities more than 2 years is currently about 4.3%. With more issuers tapping the CNH bond market going forward, we do expect the yield to gradually creep up to around 4.5 to 4.75% by the end of this year.
So against this very rapid growth in the CNH bond market as well as the rising yields, where do you see these sort of performance drivers coming from?
Well, I think the key driver of the performance is actually the massive liquidity that we are seeing in Hong Kong currently. If you look at the RMB deposits in Hong Kong, it has grown at a very phenomenal rate. It grew 400% last year, and it grew another 30% for the first 2 months of this year. So the total pool of RMB deposits currently in Hong Kong is about 411 billion RMB. This versus about 70 billion CNH bond size. So the pool of RMB deposits versus the pool of or the size of the CNH bond market is currently about almost 6 times versus only about 3 times at the end of 2019. So we have a huge pool of liquidity currently available to be invested in the CNH bond market, and it is this strong liquidity that is actually pushing up the CNH bond prices currently.
So amid this very strong growth, one of the criticisms or one of the questions that some observers have asked is whether or not there's an increased risk of default risk, as issuer quality might suffer with all this liquidity chasing all these bonds. So apart from default risk, are there any other risks that investors should take note of for the CNH bond market?
There are 2 main risks, I believe, in the CNH bond market. The first risk, as you rightly point out, is the default risk. Let me address this first. Well, the default risk, yes, I believe this risk is actually gradually rising, as over the last couple of weeks, we are beginning to see very marginal credits beginning to tap the CNH bond market for funding. And as such, we as a company, we at UOB Asset Management will not be subscribing to all new CNH bond issues. We will be very selective in participating in the new bond issues, and we will select only good credits that give very reasonable yield. Now, the second risk actually in the CNH bond market pertains to the interest rate risk. Now, I think contrary to market consensus, the key interest rate risk is actually not China tightening its monetary policy. Now, we have seen the Chinese central bank hiking the interest rate by about 100 basis points by 4 times since October last year, and thus far, I've seen very little, if any, impact or negative impact on the CNH bond market. Now, what can actually cause the CNH bond market to sell off or the yields to rise very sharply is if global interest rates begin to rise very sharply. Now, if you see US Treasury yields going up by as much as 100 to 200 basis points going forward, then definitely there will be a negative impact on the CNH bond market.
Another concern on investors' minds is the impact of currency fluctuations. How do you see currency fluctuations affecting the CNH bond market, in particular that of the renminbi versus the Sing dollar? Right,
okay. The RMB is on a steady appreciation trend against the US dollar. I predict or I think that the RMB is likely to appreciate at an annual trend of between 5 to 6% against the US dollar over the next 3 to 5 years. Against the Sing dollar is a little bit more tricky, yet the RMB has not done well against the Sing dollar over the last 1 year. In fact, it has depreciated by about 3%, 3 to 5% against the Sing dollar over the last 2 years. Now, so far this year, right, the RMB has weakened about 1.8% against the Sing dollar, although against the US dollar, the RMB has appreciated by about 1.2%. Now, I think this year, right, the RMB is likely to be at best flat against the Sing dollar. What I am predicting is that over the next 3 to 5 years, the RMB has the potential to appreciate against the Sing dollar by about 2 to 3% on an annual basis through the next 3 to 5 years. But this year alone, I think at best RMB will stay flat against the Sing dollar. At worst, it could actually depreciate a further 2 to 3% against the Sing dollar. So this is one key risk that investors have to be aware of, that if you want to buy or invest in any RMB bond fund, this is actually a long-term investment. It's not an investment for only 6 or even 12 months. And one thing to note is that while there's been a lot of focus on the lack of RMB performance over the last 1 to 2 years, I just want to highlight that the RMB has actually been the third best performing Asian FX over the last 5 years. So over the last 5 years, the number one top Asian FX performing currency is actually the Sing dollar. It went up 28% against the US dollar over the last 5 years. The second is actually the Thai baht. It went up about 25%. And the third is actually the RMB. RMB has appreciated a total of 23% against the US dollar over the last 5 years. So I think over the next 3 to 5 years, the RMB is likely to outperform the Sing dollar and most of the rest of the Asian FX, simply for the fact, for the main reason that the Chinese economy is likely to grow faster than Singapore, and secondly also because the RMB is also a lot more undervalued against the US dollar than compare the Sing dollar against the US dollar.